Hello and welcome to the Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's review the month of November. Pretty strong performance. Recap a little bit and look ahead to December and a little bit into next year.
Sure. Thanks, JR. So kind of like you said, very strong month of December. And really, if you look at it, the S&P 500, the Dow and the Nasdaq, and certain select sectors moved towards their all-time highs. You saw that all the major indexes were up for the month, but really, I think the area to focus on was mid and small cap companies. And that's where they've shown some positive momentum in a consistent way, really for the first time this year. If you dive a little bit deeper into some of the sectors, you see that the financials were the strongest performing sector year to date. And then you see some companies and sectors not performing as well. One example is healthcare. And that's a potential trend that may unfold as we look ahead based on the uncertainty with the incoming administration. As far as other areas of the market, really the bond market saw a lot of activity. You saw a pretty dramatic increase in interest rates across the yield curve, but primarily in the long term. And so you saw the 10-year rates moving towards 440, and then you saw them kind of pulling back and stabilizing closer to that 420 range. And what we're looking for there is obviously uh, lower long-term rates are more beneficial and will stimulate other parts of the economy because a lot of financial assets, a lot of mortgages and other things are priced off of the 5-year and the 10-year rate as opposed to the very short term. And the other thing to focus on is, inflation. It remains a concern, especially with some of the policies that may come. So we'll have to keep an eye on that because, again, as there's shifts in the economy, as there's any kind of realignment, some of those could provide inflationary pressures, and that will reduce the ability for the Federal Reserve to continue to cut rates as they have and as they seem to have the desire to do. Looking ahead to this month and the first couple days, we've really seen that trend continue. Rates have continued to be stable, and so as we head into the end of the year, we're going to see additional information on inflation, a little bit more earnings, but beyond that, as it starts getting closer to holiday time, activity generally slows down, and we may see that Santa Claus rally that comes from time to time.
Well, when you look at it, David, the Fed meets on December 18th, right? And when you look at the labor market data from early December, kind of confirming where some of the Fed's concerned that labor market's steady, it's okay, it's not great. They want to keep it in this range, right? And looking ahead, they're not as concerned about inflation as they've said. On the other hand, the expectations for CPI and PPI this week are uncomfortably high, right? It's not terrible, but it's something to monitor with all the exuberance in crypto assets, real estate, stock prices could lead to more inflation as the Fed looks to cut rates. Because right now it's close to 90% probability that the Fed will cut interest rates again in December. And again, as you said, watching intermediate and long-term interest rates are a bigger deal than necessarily short-term overall. So to see the 10-year interest rate, right, and you saw the bond market rally with the new Treasury Secretary appointment, with the markets feeling some favorability to budget deficits, financial um, fiscal stability and some challenges with that has been a concern because we've talked about this over the last few months. I mean, the national debt and deficit continues to rise overall. And when you look at ahead, I mean, it's not likely to slow down. And if you look at this graph, you can see the national debt is over 35 trillion, right? And going back a few years, is pretty close to the same as GDP. Now it's outpaced. So there's some feeling by the markets that you'll see some maybe fiscal responsibility to narrow that with the Treasury Secretary. On the other hand, looking at where the growth is, you're still likely to see that deficit expand over the next few years, which leads you back to inflation, as a concern looking at next year. On the other hand, like I said, the Fed's going to cut and probably another 2 to 3 rate cuts next year. That helps to reduce the interest on the debt that everybody is taxed on to pay for, which again is a positive. But looking ahead, if you take a step back now, David, and let's look at maybe, what's good, where are some of the strengths and looking into next year? Big picture, everything seems to be really, really good right now. Solid labor market, GDP, fourth quarter, 3+%. The Fed's cutting interest rates. Markets are at close to all-time highs. You would expect this to continue into next year.
Yeah, Jared. So I think kind of like you said, and maybe adding a little bit of additional detail. Like you said, GDP, which is just the overall state of the U.S. economy. Again, a backwards looking number, but what you've seen is that GDP has grown at over 2.5%, 2.8% in some cases over the last couple of quarters. The expectation, according to the Atlanta Fed, which we follow closely, is over 3%. So again, you're having robust growth within the economy, but that's looking backwards. As we look ahead, the question is, what are the areas that benefit? On the labor front, the labor market continues to expand. You do have net positive job creation month over month. You do see negative revisions from time to time, which reduce that overall number. But at the moment, again, still a net job creator. And so what that means is more people working, obviously higher overall income. We've covered that in previous conversations and previous recordings, but you do have those numbers moving higher, which leads to the consumer being able to spend. And then again, the area of strength being the interest rates moving lower, the Federal Reserve continues to want to move rates lower, and that should provide a benefit. On the other hand, you do have a number of headwinds and things that we're very cautious over. You have ongoing global conflicts in Europe, in the Middle East as well, and then you're seeing signs of instability in other regions. So as those things shift, that can have impacts to companies that rely on those parts of the world, for example, Europe, or other parts, for example, Korea, where there's a lot of manufacturing and products do come out of there. So that could impact supply chain and create other challenges. If you look at the labor market, you do see, and as we've talked about, it just hasn't been as robust as, I guess as you would like to see always, but you do have a number of job openings that are generally being reduced. When CEOs are surveyed and other professionals who, have hiring decision-making authority, they're expecting job cuts, and that's the number they've put out that's moved, higher in recent months, so indicating future layoffs potentially. And lastly, is you have the price for perfection valuations, as we call it, and really, if you look at it, the Magnificent Seven as well as other parts of the economy just really have high price to earning ratios, which are going to be a challenge if some of those valuations change over time. So those are some of the things that we're seeing as far as, again, areas of strength and potential headwinds.
Well,
But
and
within
David, to
that,
add a little bit to the strength, obviously, of the wealth effect,
Mhm.
as a major positive. Like with stock prices, 401k balances, Fidelity had a new record as far as 401k millionaires, with the markets hitting new highs. That leads to consumer confidence and future strength ahead. On the other hand, as you said, with the big concern around valuation, if the valuation and big companies just slow their growth rate down a little bit, you could see the PE ratios come down. That could cause a correction in the market and lead to, the opposite effect of the wealth effect. As you start to lose assets, you start to contain spending a little bit. So these are the things to watch for. As far as opportunities looking into year end, I mean, it feels like there's good momentum, to finish the market strong this year. I think January and beyond is really going to be what to do. Where do you allocate next year? And I think, as we've talked about, maintaining a balance when you see great results of a lot of these companies, just don't forget to take profit, keep things in context. The bond market, safer assets do provide some stability, in case there is a bigger drop next year, a correction, to kind of keep everything on track. So I think as you look to January and beyond, you'll start to see some of that rotation within the market, maybe pick up a little more steam. But again, it's not a bad time to be rebalancing your portfolio with the stock market at all-time highs, and then be mindful of the growth and opportunities with the economy and what's likely to happen next year. So with that, we want to thank you for listening this month, and hope everybody has a happy holiday season, and we'll talk next year.
Thank you.